Good morning. Welcome to Stock Market Today. It is Thursday, July 16th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show. Also give you daily stock ideas to consider. Those hit your inbox every trading day before the market opens. So U.S. equities were higher on Wednesday as small caps and cyclicals outperformed on COVID vaccine news from Moderna. At the sector level, it was industrials, energy, and financials that outperformed. Comm services and tech were your laggards. Treasuries were mixed with weakness at the back end of the curve. The dollar was lower on the major crosses. Gold finished little changed on the day. WTI crude up about 2.3% on a larger than expected inventory draw. As we get to the desk this morning, however, futures are down 80 basis points after Asian markets came under pressure last night. European equities are weaker as well. Treasuries are unchanged to slightly stronger with the curve flattening. Dollar is stronger against the yen and the euro. Gold down 30 bips. WTI crude is off 1.3% to kick us off on a Thursday morning after the S&P 500 made another push, but no breakout yet. You can see the line. You can see the attempts. We're trying to break through that 3250 level. So far, it has acted as a stone wall. Much as 3,000 on the downside has acted as a solid floor. So the support and resistance levels largely remain the same. Should we head lower from here? You have to think about 3,000 to 3,100 as remaining near-term support. Below that, 2,850 to 2,950. The Feb highs are still in play as support continues to hold. On the upside, we are in the resistance zone between 3,150 and 3,250, right? So, that's the level. We're knocking our head on it. We're trying to break through. Not able to do so just yet. Would also highlight that is around the area that holds the gap down that started the February-March downturn. Now, in the interim, we are overbought. The CCI, 13-period CCI, is overbought and negatively diverging. Notice that the index is back to the levels that were achieved in early June, but the indicator is making a lower high. Same goes for Chaikin money flow. It's bullish, but diverging. So that is an interesting dynamic at play. We're also going to look at some breadth divergences, which I highlight deeply in my note this morning. We'll touch on a few of them here today from a breadth perspective. So that's the structure of the S&P 500 as we kick it off on a Thursday. Let's hit our market in a minute. What are we writing about today? Well, small caps lead the charge on a bullish day, right? Everything was higher for the most part, but look at that outperformance by small cap. Growth lags as this crowded trend takes a breather, right? We talked about it late last week and earlier this week. The growth over value trend was somewhat extended to the upside, and it's taking a bit of a breather here. Do not think that it's a near-term shift as long-term treasuries remain supported in a consolidation. I would think that if we were seeing a shift out of growth that was going to be sustained, we'd also start to see a breakdown in long-term treasuries. So far, that is not the case. We're watching closely. Breadth metrics, as they improved on the week, but we're watching the divergences with early June. And as I said, futures point to a lower open here today. Now, as we look at the indices from a power bar perspective, the Dow tacks on 87 basis points yesterday, 5 bulls to 6 bears there. So that ratio is improving. S&P 500, 128 bulls to 81 bears in that group, up 96 basis points. So that ratio continues to improve as well. So the NASDAQ was an underperformer yesterday in a big way, right? Down, only up 19 basis points against the S&P, up nearly 1%. 38 to 9 bulls to bears, right? So continuing to improve, but just a little bit of this rotation, this shift that we're seeing in the near term. Small caps were the call out yesterday, up 3.7%. Huge thrust move to the upside in its ratio, 617 to 275 bulls to bears on that metric. Bonds downtick sending yields higher. Industrials, your outperforming group on that rotation, up 2.5%, 9 to 10 bulls to bears there. So big picture from a Chaikin Power Bar perspective, small caps and large cap stocks are bullish. Major indexes across the board are mixed. It's largely due to the Dow being skewed to the bearish side of the coin there. Let's hit our stocks, plural, of the day. Like I said, I've been getting a lot of good feedback on providing these screens once a week. So we're continuing to make it a Thursday theme. So we talked about this rotation out of growth. in the near term. Our view currently is that that's something that's not likely to be sustained, largely a function of what we're seeing in the interest rate markets. So what I wanted to do was screen a universe of growth stocks that we have here at Chaikin Analytics for stocks that have a very bullish, or a neutral plus power gauge rating here within our model. As always, I look for strong money flow and strong relative strength, but then I wanted the growth stocks that are currently oversold based on that overbought, oversold indicator. So you can see what the results of that screen are, right? For those of you who use Chaikin Analytics, you can replicate the screen here. I've left the settings in there for you. For those of you who do not, you should consider taking the 14-day trial, or in the interim, take a note of these growth stocks that have become oversold here in this growth to value shift in the interim, right? Some popular names on there like Seattle Genetics and Vertex, ResMed. Also, PennyMac Financial was my bullish call out this week in my note to clients on Sunday. That stock was up 5% yesterday. So screenshot this, take a look, take note of these names that could be presenting opportunities here and are likely leaders once growth begins to reassert its uptrend, especially relative to the value theme. Now, timing on that, it could start today. It could continue to work itself out over the next couple of days, but I'm talking bigger picture trend. I think that the growth over value theme does remain intact. Let's hit our sector tracker now. Movement over the last 5 days kind of replicates that growth to value theme. Right now, we've touched on materials a few times over the past few weeks as being our favorite of the cyclical sectors, and that's on the top of the leaderboard over the past 5 days. There's your industrials, your financials, your energy. That's kind of the rest of the group in that cyclical / value rotation, right? So that's just, it's playing out. We're seeing it. It started largely on Friday and has kind of accelerated a little bit this week. In the middle of the road, healthcare, staples, and discretionary. At the bottom of the list, there's your comms, right? Information technology, Utes, and REITs. Also at the bottom of the list during this rotation. Playing out, we don't think it's a bigger picture shift just yet, but if the data points start to point to it, we will change our mind. So far, we're not there yet. Let's look at our industry in focus. Speaking of rotation, but still, and it's not the best group on earth, right? Oil and gas, equipment and services, an utter disaster over the past 6 months, lagging the S&P 500 by nearly 51%. Power bar ratio is still weak with 9 bearish stocks for 4 bullish stocks, and it's currently ranked number 19 of 21 subsectors, and it's moved down 2 slots over the past week. Now, some of the names there that we want to avoid or potentially look for opportunities on the bearish side of the coin. Drillquip, DRQ, very bearish. Core Labs, CLB, very bearish. And Helmerich and Payne, HP, with a very bearish Chaikin power gauge rating. And as we drill down on the industry group itself, you can see a clear downtrend, right? From a big picture perspective, right? Down and to the right, not generally what you want to see if you're an owner. Take a look at the relative strength at the bottom of the screen, right? It's been a persistent underperformer for the past 12 months. Now, what I will say is that the ETF rating has shifted to neutral, and it is above the trend line, right? So some consolidation here. To me, it looks like a consolidation within the context of a bigger picture downtrend. Bearish money flow, getting closer to overbought, right? So not exactly exciting, if you ask me. Could it have a little bit of legs if this rotation continues to play out? Sure, but I think that would present opportunities on the bearish side. We're just not there yet. Slight improvement, yes. Something I really want to dive into? Not really. That's kind of my view on that group here today. Now, taking a look at yesterday's movers and shakers, the left side of the board has a clear theme, right? Moderna's news regarding their vaccine lent a bid to these stocks that were most heavily hit and most impacted by the COVID-19 virus, right? So we see a snapback rally in Royal, Norwegian, and Carnival, right, as well as American Airlines and United Airlines. Now, American did actually have some company-specific news. commentary about potentially furloughing employees in light of lower demand. Most of these stocks are still rated bearish or very bearish, right? Snapback rallies here. If you own them, probably a good opportunity to take some off the table. If you're looking for bearish setups, they might be worth doing some work on. Loser side of the board, BLL, nothing company specific there, down 5.5%. BK earnings took that stock lower by 5%. Fortinet caught a downgrade from Goldman Sachs. That stock's been under pressure with these growth names, down 3.8%. Nothing company specific in EIX, and Amazon, right, one of the big growth and momentum stocks that's seeing some profit taking here in the near term. Amazon down 2.4% on the day. So let's dive in. On Thursdays, we do breadth, right? You've seen this chart before, and what's interesting to me is the divergences, right? Take a look at the top and middle panels, the percentage of stocks above their 200-day moving average in the top. Notice that when the S&P 500, kind of topped out before going into this consolidation that we've been in for the past month, the percentage of stocks above their 200-day moving average was in the 60% area. It's actually over 65%. Today, it's lower. While the index is at the same level, right? So that's a bearish divergence. Similar dynamic at play for the percentage of stocks above their 50-day moving average, right? Back in early June, when the index was at the same level we're at currently, this metric was higher than it is today, right? Our divergences are a wake-up call. They tell you, hey, pay attention. Something's not being confirmed here, right? It's also playing out in the percentage of stocks that are above their 20-day moving average, which we touch on in our note. It's also playing out in the percentage of stocks that are on MACD buy signals in the S&P 500. So these divergences are something that we want to make investors aware of. Keep in mind that this coincides with SPY and Qs being overbought based on our overbought, oversold indicator that we use here, right? Go back to the chart earlier with the CCI 13 in an overbought condition, right? The one positive from a breadth perspective is the advanced decline line for the S&P 500. It is above, but if I look at breadth and take away to the evidence approach, I would say divergence is the theme of the day. So just something to keep in mind, right? I think you need to be more selective with your bullish ideas. Maybe wait for an opportunity. We're starting to see futures roll over here a bit this morning, right? Take a look at that screen of growth stocks that are oversold, right? And you can start to look for your opportunities, but I think you do need to be a little bit more selective here in the near term, right? And let's talk about that. I'm calling it a pause in the growth theme. Take a look at the VOOG here, the Vanguard S&P 500 Growth ETF, right? On an absolute basis, it looks fine, right? We had this breakout and a consolidation above the breakout level at $190, above a rising 200-day moving average, clear uptrend off of the March 23rd lows. At the same time, the RSI is holding bullish ranges, right? Above 50, series of higher lows on the part of the RSI. Small divergence here, sure. And now we're consolidating. The bottom of the chart, we're looking at it relative to the S&P 500 value ETF, right? And you can see that pullback, right? Still in a steady uptrend, still above the breakout level, but here's this pullback over the past week or so of trading, right? So that trend is very much still intact, right? To me, it likely presents an opportunity. If it was to continue over the next couple of days, we'd look for these support levels to hold on a relative basis. We'd look for the fund itself to hold above this breakout level at 190 while the RSI remains in bullish ranges. To me, that sets up looking at those growth screens and looking for your opportunities, especially in light of the fact that treasuries remain bid, especially long-term treasuries. Take a look at TLT here, the 20-year plus treasury bond ETF, still in an uptrend, near-term uptrend, breaking out of a consolidation, above the 50-day, above the 200-day, RSI and bullish ranges, and TLT relative to ag, right? So bigger picture bonds, broke the downtrend line and continues to move higher. For me to think that growth over value is rolling over, I would expect to see treasuries roll over as well. That'll wrap us. Take us for a test drive. I'm back at you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.